All right, let's get right into it. Today we're going to take a look at the latest quarterly results from the agricultural giant Wilmar International. And, on the surface, they tell a really confusing story. It's one of those real head-scratchers that forces you to look past the headlines to find out what's actually going on.
And boom, here it is, the central mystery right up front. On one hand, the company's core profit, well, it soared an incredible 71.6%. That's fantastic. But then you look at the other side, the official net result, and it's a staggering loss of nearly $348 million. So, how can a company be doing so well and so poorly at the exact same time? That's what we're going to unpack.
So to solve this puzzle, we've got to look at the engine of the company first, its day-to-day business. This is the good news part of our story, and it's all about a little something called core net profit.
Now, it's really crucial we understand this term. Think of core net profit like this. It strips away all the weird, one-time events, like selling off a building or a huge legal settlement. It gives you the clearest possible picture of how the actual business is performing. Is it making and selling its products profitably every day? That's the question this number answers.
And Wilmar's answer to that question is a huge yes. Their core net profit for the quarter was over $357 million. And look, this isn't just a good number, it's a massive 71.6% jump from the same time last year. So the fundamental business isn't just healthy, it's absolutely thriving.
So where did all this growth come from? Well, it was pretty much across the board. Their food businesses in China did really well. At the same time, because there were huge soybean harvests in South America, they could process soybeans more profitably, especially with all the demand from the livestock industry. You add higher sales in tropical oils and steady palm oil prices to that mix, and you've got almost every part of the business just firing on all cylinders.
And this chart just brilliantly illustrates the point. It wasn't just about making more money on each sale. Nope, they were also just selling more stuff. Sales volume for their food products was up 6.5%, and their feed and industrial products grew over 3%. So you've got more sales and better margins. That's the perfect recipe for a stellar core profit.
Okay, so if the business is so strong, we have to face the other side of the story. Where in the world did that massive net loss come from? This is the bad news part, and it all boils down to one single, gigantic number. This is the question we started with, right? A $357 million core profit, but a $348 million net loss. The math just doesn't seem to add up. There's a piece of the puzzle missing, and it's a very expensive piece.
And here it is, $712,300,000. Just let that sink in for a moment. This is the figure that completely flipped Wilmar's financial results on their head. It's an enormous, one-time event that has absolutely nothing to do with their performance in this quarter.
So what was it for? Well, this was a massive payment that came from a legal ruling in Indonesia. And it's connected to events that happened way back in 2021 during a cooking oil shortage in the country. This isn't an operational cost. It's a non-recurring legal charge from the past that they just had to pay out now.
And that, right there, brings us to the key distinction, probably the main takeaway of this whole explainer. The core net profit shows us that the ongoing business is very healthy. The net loss, though, was caused entirely by that single, backward-looking legal payment. One number tells you about the future, the other tells you about the past.
So, knowing all this, we can look right past that scary headline loss and ask a much better question. Is the company financially stable overall? Because profit is just one piece of the pie. Let's take a quick look at the balance sheet.
And the picture here is actually really positive. Despite having to pay out over $700 million, Wilmar actually reduced its total net debt. It's down nearly 12% just since the start of the year, sitting at about $16.5 billion. So they're actively managing and bringing their debt down.
Another great way to check on a company's stability is its net gearing ratio. Don't worry about the fancy name. It's basically just a way to measure how much debt a company has compared to its own money. And just like with your own personal finances, a lower ratio is almost always a healthier sign. And Wilmar's ratio? It has improved a lot. It dropped from 0.94 at the end of last year all the way down to 0.82. This tells us that even with that huge legal payment, the company's financial foundation has actually gotten stronger and less risky this year. And hey, if you needed any more reassurance, here it is. The company has access to nearly $37 billion in unused credit lines from banks. That is a massive financial safety net. It gives them incredible flexibility, and it proves they have the full confidence of their lenders.
Okay, so we've untangled the paradox. The core business is strong, that headline loss was just a one-off event from the past, and the company's overall financial health looks pretty solid. So what does the company itself think is going to happen next?
Well, here's the official word. They acknowledge the hit from the legal payment, but they expect the business to stay resilient. Their outlook is cautiously optimistic that the year is going to end on a satisfactory note. Essentially, they're betting on the strength of that core engine we talked about at the beginning.
And that kind of leaves us with a final thought. This whole story is a perfect reminder that the big, flashy headline number, whether it's a huge profit or a scary loss, it often doesn't tell the whole story. So, the next time you see a company's results, you got to ask yourself, are you looking past the headline to understand what's really going on underneath?